On the morning of January 21st, 2026, something unprecedented occurred inside the Chicago Mercantile Exchange's silver futures pit, a market that has priced industrial metal for institutional players, sovereign mints, and bullion banks since 1963, and the silence that followed tells you everything the headlines won't. At 9:47 a.m. Eastern, the March 2026 silver contract, ticker symbol SI, experienced what traders call a no-bid event. For 11 seconds, not a single buy order existed on the order book at any price within the exchange's circuit breaker bands. To understand why that matters, you need to know that COMEX silver is not a niche corner of finance. It is the global reference price for physical silver, the benchmark against which every coin dealer in Oklahoma, every solar panel manufacturer in Shenzhen, every central bank deciding whether to restock its strategic reserves calibrates value. When that market goes silent, even for 11 seconds, it is not a glitch. It is a symptom of structural dislocation between the paper contracts traded in New York and the physical metal those contracts are supposed to represent. Within 2 hours of that no-bid window, the CME Group, COMEX's parent, issued a terse 8-line statement citing temporary liquidity imbalances in the delivery month, a phrase that sounds bureaucratic until you realize it is exchange speak for "we cannot find enough physical silver to satisfy the long contract holders who are demanding delivery, and the short sellers who promised to deliver that metal are now scrambling." By lunchtime, spot premiums on 1,000-ounce COMEX bars had spiked to 1.87 over the futures price, a spread that in normal markets runs 5 to 15 cents. And by the closing bell, dealers in Zurich, London, and Singapore had quietly pulled their bids, effectively stopping the international wholesale market cold. This is not a one-day anomaly. It is the surfacing of a pressure wave that has been building since late 2024, when industrial demand for silver, driven by solar panel production mandates in the EU and China, plus military electronics procurement tied to NATO expansion, began outpacing global mine supply by an estimated 220 million ounces annually, a deficit that can only be filled by above-ground stockpiles, which are now measurably vanishing. The COMEX's registered inventory, meaning silver that is both in the warehouse and available for delivery, has dropped from 78 million ounces in October 2025 to just 41 million ounces as of last Friday. And here's the critical fact. Roughly 340 million ounces of open interest, paper claims, are outstanding against that shrinking pool of metal, a ratio of 8.3 to 1, meaning for every real ounce sitting in a New York vault, more than 8 contracts are claiming ownership of it. That is not a market, that is a musical chairs endgame, and the music just stopped for 11 seconds on Tuesday morning. Now, if you are over 40, if you remember the Hunt Brothers squeeze in 1980 or the nickel short squeeze on the London Metal Exchange in 2022 that cost one Chinese tycoon $8 billion and forced the LME to cancel trades, you know what happens next. Either the exchange changes the rules to protect the shorts, or the shorts get obliterated and the price goes parabolic and either outcome breaks something. What makes this different from prior squeezes is that the stress is not speculative. It is structural. Solar panel manufacturers are not gambling. They need physical silver to meet government contracts. Military contractors are not flipping. They need silver for missile guidance systems, radar, and EV charging infrastructure tied to defense grid upgrades. Sovereign mints in India, Mexico, and Australia are not trading. They are buying physical silver to strike legal tender coins that their populations are demanding as a store of value in an environment where bond yields are negative in real terms, and trust in fiat currency is eroding among pensioners who watched their purchasing power collapse during the 2021-2023 inflation wave. These are not weak hands. These are entities with balance sheets, lawyers, and political backing, and when they stand for delivery, they do not accept cash settlement. They want metal, and the shorts cannot print metal. The no-bid event on Tuesday was not a moment of panic. It was a moment of recognition among the smart money that the paper game is ending, and the physical game is beginning. And in that game, the rules are older and simpler. If you do not hold it, you do not own it, and if you promise to deliver it and you cannot, you are in default. And default in a commodity market does not mean a phone call from a lawyer. It means margin calls, forced liquidation, clearinghouse stress, and, if the positions are large enough, a systemic event that bleeds into credit markets because the same institutions shorting silver are often leveraged across multiple asset classes. The CME's statement mentioned temporary liquidity imbalances, but veteran traders noticed something else in the fine print. The exchange raised initial margin requirements on silver futures by 18% effective immediately, a move that forces both longs and shorts to post more cash collateral, which in a normal market would calm volatility. But in a delivery squeeze, it does the opposite. It forces weak shorts to cover because they cannot afford the margin, which drives the price higher, which triggers more margin calls, which creates a liquidation cascade. And here is the detail that should concern you. 3 of the top 5 short position holders in COMEX silver, according to the latest Commitment of Traders report, are institutions classified as swap dealers, meaning they are not miners hedging production or manufacturers hedging input costs. They are financial entities that sold silver they do not have, betting the price would fall or that they could roll the contracts forward indefinitely without ever delivering, a strategy that works beautifully in a liquid market with ample physical supply, but becomes a nightmare when supply tightens and long holders refuse to roll. One of those swap dealers is rumored, though not confirmed, to be a European bank with exposure to Italian sovereign debt. And if that bank is forced to cover a multi-billion-dollar short position in silver, at the same time it is managing a bond portfolio under stress, you are looking at a scenario where a commodity squeeze becomes a credit event. The next 48 hours matter because Friday is first notice day for the March contract, meaning longs must declare their intention to take delivery, and if a significant percentage stand for delivery, and all signals suggest they will, the shorts will either have to source physical metal at any price, or negotiate cash settlements at premiums that could run 20%, 30% or higher, or appeal to the exchange for emergency rule changes which would trigger a credibility crisis in the broader commodities complex. What you are watching is not a price spike, it is a regime change, the moment when a paper market collides with physical reality, and the institutions that built their models on infinite liquidity and fungible contracts suddenly realize that metal has weight, location, and scarcity, and none of those can be hedged with an Excel formula. But before we talk about what this means for your portfolio, your purchasing power, and the doors that are quietly closing on retail access to physical silver this week, you need to understand the one mechanism the exchange has left to contain this, and why using it might break the market worse than doing nothing. The mechanism that matters now is not the price. Price is just the symptom. It is the clearinghouse settlement chain, specifically the role of the Depository Trust and Clearing Corporation's Commodities Division and the CME Clearinghouse, which sits between every buyer and seller in the COMEX silver market and guarantees that if you are long a contract and demand delivery, you will receive either metal or cash, and if you are short and fail to deliver, the clearinghouse will step in, source the metal, and send you the bill, plus penalties. That structure works flawlessly when the clearinghouse has access to a deep liquid pool of physical silver, dealer inventory, refiner stocks, emergency bullion bank lending. But it breaks when that pool evaporates because the clearinghouse does not own silver. It brokers it, and brokering requires willing sellers, and right now, the sell side has gone dark. Here's what happened behind the scenes between Tuesday's no-bid event and Thursday morning, reconstructed from 3 independent sources inside bullion banking. The CME Clearinghouse contacted 7 authorized silver depositories, these are the vaults in New York, Delaware, and Chicago that hold COMEX registered metal, and asked for immediate availability quotes on 5 million ounces, roughly 5,000 of the 1,000-ounce bars that constitute good delivery, and 6 of the 7 depositories responded with either no available inventory or quotes that were $2.40 to $3.10 above the prevailing futures price, premiums that would make delivery economically ruinous for the shorts. The 7th depository, a facility in Wilmington operated by a Canadian bank, offered 1.2 million ounces at a 1.95 premium, but attached a condition. Payment in full within 24 hours, no rollover, no credit line, physical pickup only, no intervault transfer. That is not normal commercial terms. That is a counterparty saying, we do not trust the system to remain solvent long enough to clear a standard settlement, and when a bullion bank that has cleared COMEX metal for 30 years starts demanding cash and carry terms, you are no longer in a market. You are in a run. The clearinghouse now faces a choice. It can enforce delivery, which means forcing the shorts to pay those premiums and take possession of metal that may not exist in sufficient quantity, triggering a cascade of defaults among smaller traders and potentially 1 or 2 mid-sized institutions. Or it can invoke Rule 760, the CME's emergency authority to declare a delivery impracticable and mandate cash settlement at a price determined by a 3-member panel, which sounds orderly until you realize that every long who stood for delivery did so because they want metal, not dollars, and forcing them into cash settlement at an exchange-determined price, likely below the panic bid they could get in the physical market, amounts to a confiscation of their contractual right and will trigger lawsuits, congressional inquiries, and a permanent loss of confidence in futures markets as a hedging tool. This is the trap the London Metal Exchange fell into in March 2022 when nickel spiked from $29,000 to $101,000 per ton in 36 hours due to a Chinese short squeeze. The LME canceled $3.9 billion worth of trades to prevent the default of a politically connected Chinese metals tycoon, and the fallback was immediate. Hedge funds pulled billions in margin, traders fled to over-the-counter markets, and 2 years later, nickel open interest on the LME is still 60% below pre-crisis levels because nobody trusts an exchange that will rewrite the rules mid-game to save insiders. The CME knows this, which is why they have not yet pulled the trigger on cash settlement, but the clock is running. First notice day is Friday, and as of Wednesday's close, 14,200 contracts representing 71 million ounces were still open in the March delivery month. And if even half of those stand for delivery, and chatter on institutional trading desks suggests the number could be higher, the clearinghouse will be on the hook for 35 million ounces against a registered inventory of 41 million, leaving just 6 million ounces of buffer, and that buffer is not static because eligible inventory, meaning silver in the warehouse but not yet registered for delivery, can be withdrawn at any time by the owners, and withdrawals have been accelerating. On Monday alone, 1.8 million ounces were pulled from eligible stocks at the CME's New York vault, and while the exchange does not disclose who withdrew the metal, the timing, 72 hours before first notice day, suggests that large holders are moving metal out of the COMEX system entirely, either into private storage or offshore, because they no longer trust that the exchange can or will honor delivery obligations without rule, changes that disadvantage longs. Now, if you are holding physical silver in a safe deposit box or a private vault, you are watching this and thinking my metal is safe. And you are right. But the second order effect is what you need to watch, because the retail pipeline is downstream from the wholesale market. And when wholesale disappears, retail premiums go vertical. As of Thursday morning, major U.S. dealers, APMEX, SD Bullion, JM Bullion, were quoting 1-ounce American Silver Eagles at $650 to $780 over spot, compared to the normal $350 to $450 premium, and several products, including 100-ounce bars and Canadian Maple Leafs, were listed as temporarily out of stock or available for pre-sale with 4 to 6 week delivery, which is dealers speak for, we do not have the metal and we are not sure when we can source it. The reason is simple. Retail dealers source their inventory from the same wholesale market that is now freezing up, and when they can no longer buy 1,000-ounce COMEX bars at spot plus 40 cents and slice them into retail products, they either raise premiums to ration remaining inventory or stop selling entirely, and we are seeing both. In Europe, the situation is more acute. The Royal Mint in the UK suspended online sales of Silver Britannia coins on Wednesday due to unprecedented demand, and in Germany, the largest bullion dealer, Pro Aurum, is quoting 12-15% premiums on silver bars with delivery in March, up from the usual 4 to 6%, and requiring prepayment, no holds, no layaway. This is not a price story anymore. It is an allocation story, and allocation is always the prelude to rationing, and rationing in a commodity market means the people with the least leverage, retail buyers, small businesses, late movers, get priced out or shut out entirely, while the institutions with credit lines, vault access, and CME membership get first call on whatever metal remains. The people trapped in this mechanism are not the industrial users. They have long-term supply contracts with miners and refiners, often at fixed prices with delivery guarantees, and they are not the mints, which have government backing and can requisition metal if necessary. The people trapped are the paper shorts who sold silver they never had, the retail investors who assumed they could always buy metal at a reasonable premium when they needed it, and the pension funds and family offices that hold silver ETFs like SLV, which are supposed to be backed by physical metal, but whose prospectuses contain clauses allowing the trustee to settle in cash in the event of market disruption or force majeure, language that nobody reads until it is too late. The smart money is not debating whether the clearinghouse will intervene. They know it will. They are positioning for what comes after the intervention, because once an exchange cancels contracts or forces cash settlement to prevent a systemic default, the message to every market participant is clear. Property rights in paper markets are conditional, enforcement is political, and the only claim that cannot be diluted by a rule change is the metal in your hand. But here's the detail that connects this to your kitchen table, your retirement account, and the decisions you need to make this weekend. Because the breakdown of the COMEX settlement chain does not stay in the futures market, it radiates outward into every corner of the economy where silver is used, priced, or stored, and the speed of that radiation is faster than most people expect. What this means for your household is not abstract. If you heat with natural gas or electricity generated from natural gas, the turbines and control systems that regulate that grid rely on silver-based contactors and switches that utilities purchase on multi-year contracts indexed to COMEX prices. And when those contracts roll over in Q2 and Q3 of 2026, the new pricing will reflect not the $29 spot price you saw in December, but the replacement cost in a market where physical premiums have doubled or tripled, and utilities do not absorb cost increases. They pass them through to ratepayers with a 90 to 120-day lag, which means your heating bill in June or July, just as summer cooling demand hits, could reflect a commodity shock that happened in January, but took 2 quarters to reach your mailbox. If you own or are considering solar panels, the math just changed. Residential solar installations require roughly 20 grams of silver per panel for the photovoltaic cells and bus bars that conduct electricity. And while 20 grams sounds trivial, a standard 6 kilowatt home system uses about 30 panels, which is 600 grams or roughly 19 ounces of silver. And if the wholesale price of silver rises 40% and premiums add another 15%, the all-in materials cost for that system goes up $600 to $900, and installation companies are already revising their quotes for jobs scheduled after March 1st. And some are inserting force majeure clauses that allow them to reprice if commodity costs spike before delivery, which means the $18,000 quote you received in December might become $19,500 in February with no recourse. If you are retired or within 5 years of retirement, the part that should concern you is not silver itself. It is what silver's breakdown signals about the broader commodity complex and the financial system's ability to manage physical delivery in a world where just-in-time inventory and financialized commodity trading have replaced the old model of strategic stockpiles and long-term supply agreements. Copper, platinum, palladium, even aluminum are all traded on similar futures exchanges with similar leverage ratios and similar dependencies on clearinghouse trust. And if the COMEX silver market breaks and the CME is forced to intervene with cash settlement or trade cancellations, every trader in every commodity pit will draw the same conclusion. Futures contracts are no longer reliable hedges, physical delivery is no longer guaranteed, and the only safe position is to own the underlying asset outright or stay out of the market entirely, and that loss of confidence does not rebuild quickly. It took the LME 2 years and a complete overhaul of its governance structure to partially restore credibility after the nickel debacle, and open interest still has not recovered. For those of you who already own physical silver, the next 48 hours are decision time. Do you sell into this spike, take profits, and redeploy into assets that are less volatile, or do you hold through what could be a multi-month squeeze on the assumption that the current premium spike is not a peak, but a re-rating? A permanent shift from the old equilibrium where silver traded like an industrial metal with modest inflation hedging properties to a new equilibrium where it trades like a monetary metal with strategic scarcity and sovereign demand. The answer depends on your time horizon and your trust in institutions, because if the CME forces cash settlement, the paper price could actually fall even as physical premiums rise, creating a bifurcated market where futures traders get crushed and physical holders get rewarded, and navigating that bifurcation requires you to know which market you are actually in. If your silver is held in an ETF like SLV or SIVR, you are in the paper market, and you are exposed to whatever settlement mechanism the trustee chooses. If your silver is in your possession or allocated storage with a non-bank vault, you are in the physical market, and your risk is liquidity and bid-ask spread, not counterparty default. The signals to watch this weekend are specific. First, monitor whether the CME issues any further rule changes or margin adjustments after Friday's close. Any announcement released after 4 p.m. Eastern on a Friday is a red flag that they are trying to bury bad news in the weekend news cycle. Second, check whether registered COMEX inventory drops below 38 million ounces, which would represent a 50% drawdown from the October 2025 peak and would likely trigger emergency consultations between the exchange, the CFTC, and the Treasury Department. Third, watch the Shanghai Gold Exchange Silver Premium. If the premium of Shanghai physical silver over COMEX futures exceeds $4 per ounce, it signals that Asian buyers have lost faith in Western paper markets and are pulling metal east. A flow that once started is very difficult to reverse because China does not export silver. It only imports. Fourth, pay attention to whether any of the large short holders quietly exit their positions over the next 2 weeks. The Commitment of Traders report is published with a 3-day lag, so the February 4th report will show positioning as of February 1st, and if you see a sudden drop in swap dealer shorts, it means someone paid an enormous premium to get out, and the question becomes who is left holding the bag. And finally, the choice that some of you are already weighing. Do you try to buy physical silver this weekend, before first notice day, betting that premiums will go higher and availability will get worse? Or do you wait for the situation to resolve, hoping that the CME intervention or a collapse in paper price will create a buying opportunity? The risk of waiting is that if this is a genuine supply crunch and not just a liquidity panic, the window to acquire metal at any reasonable premium may close for months, and when it reopens, the new normal could be $8 or $10 over spot with 6-week delivery times. The risk of buying now is that you pay peak premiums into a spike that resolves quickly, leaving you underwater on a 15% or 20% premium that evaporates by April. There is no safe answer, only trade-offs. But here is what the institutional desks are doing, the ones that called the Treasury spike in 2023 and the regional bank crisis before the headlines. They are not buying paper, they are not waiting for a dip, and they are not trusting the clearinghouse to deliver. They are taking possession, moving metal offshore or into private vaults, and treating this as the beginning of a longer repricing cycle, not the end of a short-term squeeze. Because once a market loses the belief that paper and physical are interchangeable, getting that belief back requires years of boring stability. And stability is not what the next 6 months look like.